All right, today we're putting on our detective hats to crack a financial mystery. This is a puzzle that has stumped some of the brightest minds for decades, and it's been hiding in plain sight, right in the stock market. And trust me, by the end of this, the answer we find is going to change how you think about risk.
So, here's the game plan. We're going to start with the puzzle itself, this stubborn mystery of value stocks. Then we'll see why the usual tools, the standard models, just couldn't crack the case. After that, we follow a trail of clues back to the 1930s, which leads us to a pretty radical theory about risk, one that ends up solving a whole bunch of other mysteries along the way.
Okay, so for the better part of a century, there's been this glitch in the market, a pattern that really defies common sense. It's something that just shouldn't happen, but it keeps on happening, and the data is undeniable. And that brings us to the big question, the heart of this whole mystery. Why do the boring, old-school, predictable stocks, the ones nobody really gets excited about, consistently wipe the floor with the flashy, high-flying, next big thing kind of stocks? It just doesn't feel right, does it?
So, let's meet our two main players. On one side, you've got value stocks. Think of a company with a ton of physical stuff, factories, machinery. Its stock price is kind of low compared to all the actual assets it owns. Then you've got growth stocks. Here, you're buying the dream. The stock price is high because everyone's betting on its future, not what it owns today. Think innovative tech companies.
Okay, now get this. The numbers are just wild. From 1963 to 2017, value stocks returned more than double what growth stocks did, every single month, on average. Now, Finance 101 tells you that to get a higher return, you have to take on more risk, right? But look at the market risk, the beta. It's practically the same. That's the puzzle. More money for what looks like the same risk. How is that possible?
So, when faced with a puzzle like this, economists have a go-to tool, their magnifying glass, if you will. It's been the foundation of finance for over 50 years. But here's the spoiler, for this particular case, it's completely useless. That tool is called the Capital Asset Pricing Model, or CAPM for short. And the idea behind it is actually pretty simple and elegant. It just says the only risk you should really get paid for taking is the kind of risk that affects the entire market, the stuff you can't get rid of by diversifying, and we measure that risk with something called beta. And this is the exact spot where the CAPM just falls flat on its face. Even after you account for all the risks the model can see, those boring value stocks still came out ahead by an extra 0.43% every single month. In finance, we call this alpha. It's like free money, and according to the theory, it just shouldn't be there. The model's completely stumped.
Okay, so the modern data is a dead end. What does a good detective do? You look at the cold cases, you go further back in time, and it turns out there's a crucial clue hiding in the single worst economic period we've ever seen. So, just to recap, here's what the crime scene looks like in our modern era, post-1963. You've got this huge unexplained return, this alpha, and a beta that's so close to zero it's almost funny. It looks like there's zero connection between risk and return. It's a total mess.
But now, watch this. This is the key. When we expand our timeline all the way back to 1926, which includes the Great Depression, everything changes. Suddenly, that unexplained alpha gets cut by more than half. And the beta? It's not zero anymore. It's a big, meaningful number. All of a sudden, the model starts to make a little more sense.
And that right there is our smoking gun. It turns out that during the absolute chaos of the 1930s, the crashes and the crazy recoveries, value stocks and the rest of the market moved together, almost perfectly. So the risk isn't something you see day to day. No, it's a hidden risk, a monster that only comes out when things get really, really bad.
So that clue from the past leads us straight to the solution, the big reveal. And the theory is that the risk we've been looking for isn't about the little bumps and wiggles in the market. It's about something way bigger and, frankly, way scarier.
And it's called the disaster hypothesis. The idea is simple but powerful. That extra return from value stocks, it's not free money, it's hazard pay. It's the compensation investors demand for the terrifying possibility that when a true once-in-a-century economic disaster hits, those are the stocks that are going to get absolutely annihilated.
The authors of the paper have a great way of putting it. They say disasters turbocharge what happens in a normal recession. You know, we already knew value firms have a tough time in a downturn. This theory says, in a real catastrophe, that tough time becomes an extinction-level event for them.
Here's a simple way to picture it. Your classic value firm is a massive factory with tons of expensive, specialized equipment bolted to the floor. Your growth firm? It's a software company, a bunch of laptops and code. Now, imagine a sudden economic ice age hits. Who survives? The software company can pivot, work from anywhere, but that factory, it's just stuck with a bunch of cold, useless metal it can't get rid of. That, my friends, is disaster risk.
You know, the cool thing about a really good theory, a really elegant solution, is that it doesn't just solve the one mystery you're working on. It starts solving other ones you weren't even looking at. And that's exactly what happens here. For example, let's talk about another famous financial puzzle, the beta anomaly. The theory says high beta stocks, the really volatile, supposedly risky ones, should give you higher returns. But when you actually look at the data, they don't. The line is just flat. It's baffled people for years. Why?
Well, the disaster theory waltzes in and says you're using the wrong ruler. The beta we normally calculate is based on the last few years of data, which are almost always normal years. But the true beta, the real risk, includes that tiny chance of a catastrophe. Our standard measurement is completely blind to that risk. It can't see the cliff at the end of the road, so it tells you the road is perfectly safe.
And it's not just that one. The theory also explains why another big, important model fails. It turns out that when a disaster hits, all the nice, simple, straight-line relationships that our models assume, they just break. Things get weird and nonlinear, and the standard toolkit just can't handle it.
So, we've followed the clues, we've unmasked the culprit, and now it's time for the verdict. And the conclusion really forces us to change the way we have to think about risk.
So let's boil it all down. What are the big takeaways here? 1. That value premium, it's almost certainly your payment for taking on rare disaster risk. 2. The standard models we use are great for normal times, but they're blind to these extreme events, and that's why they fail. 3. A stock's real risk isn't just how much it bounces around day to day. And 4, and this is a big one, we are all biased. We look at the world based on our recent experience, and that means we systematically underestimate the possibility of things going horribly, horribly wrong.
So here's the bottom line. Risk isn't just about the bumps in the road. It's about the tiny but very real possibility that the road just ends at a cliff you didn't see coming. And that brings us to one last, pretty unsettling question. This whole theory was built by looking into the past. So, what about the future? What rare disasters are we all collectively ignoring right now, just because they haven't happened yet in our lifetime?